listening to this OMFIF video. I'm Ellie Groves, Managing Director for the Economic and Monetary Policy Institute here at OMFIF. We will be discussing the euro area, the monetary policy response to high inflation, the market reaction, and issues of energy security and productivity. Where does this leave Europe? And who better to discuss this with than the ECB, Amundi, and the former governor of the Norges Bank? We have all of our bases covered. So without further ado, I'm very pleased to welcome Katrin Assenmacher, Head of Division Monetary Policy Strategy at the European Central Bank. We have Didier Borowski, Head of Global Views at the Amundi Institute, and Øystein Olsen, who served as Governor of the Central Bank of Norway from 2011 to 2022. So very recently left the office, but very pleased to have all of you here. Thank you so much. I'd first of all like to go to Katrin to offer your thoughts on the macroeconomic environment that Europe finds itself in. Following the ECB's announcement and raising interest rates by 50 basis points, please could you give context to this decision and the forecast for inflation?
Thank you very much, Ellie, for having me here. I'm very pleased to talk to you and this audience. First, let me say what I'm saying is my personal views, and it's not necessarily coinciding with the views of the ECB or the Euro system. As to your question, so we had the last projections in June. So this is fed into the previous round. And in these projections, we had a downgrade of the growth outlook and a worsening of the inflation outlook. So inflation was projected to be higher than in the March projection rounds. So now for July, we had a further update. And in the short run, so this was not a full projection round, but it was just looking how the inflation outlook had evolved over time. And we saw that there was a further worsening of the inflation outlook. So we have, for example, the survey of professional forecasters who went up in the longer run. We now have, for the first time, an inflation outlook which doesn't fall as quickly as previously seen, but comes 2% from above. So before it was always that it spiked up because of energy, then it dropped very strongly, and then it went up again. So now we see that inflation is higher than projected and that it's more persistent than initially thought. And in addition, we had the June number for inflation, which was also higher than anticipated. So against this background, the Governing Council decided to deviate from its previous guidance that it issued in June and to go for a 50 basis points interest rate increase instead of a 25 basis points increase. And an additional feature that was contributing to that decision was, of course, the approval of the transmission protection instrument. So by having an instrument that can be employed if spreads would become, would increase in an unwarranted and disorderly way, the Governing Council can intervene in public debt markets. And this, of course, helps with the normalization of interest rates.
Thank you very much. We will definitely get on to the transmission protection instrument in a little bit later on. But first, I'd like to go to Didier and ask how markets reacted to the higher than expected interest rate rise and your perspective on the macro environments that you see.
Well, first, just a perspective on the macro environment, and also a few words on the reaction from the ECB. So that's clearly on the growth front, we have downgraded, our growth expectations, both in the United States and in Europe, to below potential in the United States. We have no recession in the United States. We have a kind in our central scenario of stagnation of economic activity until the end of the year in the Eurozone, but risks to growth are tilted to the downside, while risks to inflation remain tilted to the upside. And it's a typical stagflationary environment. So in the worst case scenario, if Russia decides to cut off gas supply to Germany in the coming months, we may have a pronounced recession in the Eurozone with higher inflation. That's basically a nightmare for a central bank like the ECB or for any central banks, because in fact, no central bank have dealt with that kind, in fact, of environment over the past decades. So clearly, inflation expectations are not well anchored, and markets, in fact, reacted, I would say, positively to the decision coming from the central bank, despite the fact that de facto the forward guidance is dead. But I think that in an environment where you have so much uncertainty, it's rational, in fact, to end the forward guidance and to leave the door open to different possibilities, depending on economic data, but also depending on in which scenario we are going what will be the scenario in September, October, or November. So the door is open for the ECB. I think it's good news for investors, because at the end of the day, it means that the ECB takes into account very seriously its mission to anchor inflation expectations. That being said, regarding the ECB, I think there is a consensus to say that the ECB does not have the same room for maneuver as the Federal Reserve. So one thing is to start hiking rates and to abandon negative rates. Another thing would be to hike rates aggressively. We do believe, and investors believe, that the ECB doesn't have the means to hike rates aggressively, given the gloomy picture on economic activity. But the ECB was late, and I think it was good news to see a reaction from the ECB. And we'll say a few words on the TPI, because I think it's impossible to understand the market reaction if we don't look at the same time at what the ECB did in terms of interest rates and the launch of a new program like the TPI.
Thank you. And we'll, as I said, we'll get onto that a little bit. But before, Øystein, I would like to ask you, with the inflationary pressure and the dependence on Russian gas within Europe, do you give your thoughts on the options available to Europe in the replacement of Russian gas? Will this be an option, especially if Russia cuts off supply during the winter months, but also your perspective on what might happen to the inflationary outlook within Europe, looking from a former central banker?
Well, first of all, Ellie, thanks for being here. It's always a pleasure to join the OMFIF event. And I think on your question, we all have thoughts of what's happening these days. I mean, we live in a time where we perhaps experience something like a perfect storm. We have a new global crisis replacing or adding actually to the ones we have before. The most recent and definitely the most serious one is the Russian invasion in Ukraine, which has also severely affected the economic prospects, as Katrin just a few seconds ago informed us on. Well, I think the growth prospects are already affected markedly. Then inflation is back, and more than that, also high numbers. We have relative price shocks, which always will be very difficult to handle by central banks, because the starting point is a major shock in energy prices, in raw material prices, in food prices. It shifts shocks in relative prices. And these kind of events are always difficult to handle and manage from the perspective of central banks. And that dilemma, which all central banks these days are aware of, is how they have to react, and they are about to raise in policy raise markedly. But at the same time, the dilemma is that they don't want to kill the recovery. The recovery was well underway before February 24th. Now that constitutes a major dilemma for central banks. And then we have the energy security issues which have come up, which also are not quite new. I mean, the energy crisis in Europe, restricting myself to Europe now, has been mounting for some time. Energy prices were high even before the invasion. But then when Russia invaded Ukraine and we had these shocks and cutoffs and potential cutoffs of supplies, prices went through the roof. And then the European authorities and the Commission in particular they have reacted strongly. And I mean, I think we live in a time where we see a change, significant change, not also in energy policy, in direction of much more focus on energy security, and we all listen, and we wonder what's going to happen if Mr. Putin is cutting off and continuing that policy gas supplies to Europe the coming winter. So I mean, we're living in unprecedented times.
Thank you. Katrin, I want to go to you about the monetary policy toolkit and the transmission protection instrument that we spoke of, but also touch on that very good point that Øystein just made, that actually central banks aren't there by themselves, and the work that the whole of the ecosystem needs to do. I think that we've seen that with the Next Gen EU and the European Commission stepping up. And so just the interplay between monetary policy and fiscal, obviously, there is a level of independence there, which is very important, but also a level of working together. So both the TPI and also the wider ecosystem of Europe.
Yeah, so the TPI is an instrument that allows the ECB to intervene in markets if spreads widen in a disorderly and unwarranted way, which is not warranted by country fundamentals. And this is much more likely to happen in the monetary policy normalization phase than in the phase where interest rates were low and were expected to remain low for a long time. And if I may react to Didier, so we see that there is an increasing risk of inflation expectations de-anchoring. But if we look at the long term, they are still well anchored. And if we look at wage growth is still moderate. So it's now around 2%, 3%. But if you think of productivity increases, this would be still very much compatible with the ECB's inflation target. And we also have to think that the real interest rate, the neutral interest rate in the euro area, which can only be estimated, but presumably it's quite low. And so therefore, we will have a monetary policy normalization already at a terminal rate that it's not very elevated. So I wouldn't say that the ECB is far too late. So we are seeing signs that monetary policy, of course, it has to be on a normalization path because inflation is high and inflation expectations have increased, but you cannot say that it's behind the curve, and that it's hiking less aggressively than other central banks is warranted by the economic outlook and the inflation outlook in the euro area. So regarding to the interaction with fiscal policies, so we have seen in the pandemic that fiscal policy stepped in, and this of course is alleviating the work for monetary policy. And we also now see that fiscal policy is tackling the inequalities that arise from the energy shock and also from the tightening monetary policy. And this is a good thing because this is something a central bank cannot address. And so the monetary policy is always affecting all sectors in the economy. So therefore, if there are specific issues that arise with the energy price shock, with a certain inequality that in particular poorer households are more affected by the rise in energy costs. So this is something fiscal policy has to step in, and we have seen a big reaction in the euro area. So this helps monetary policy to stay its course.
Thank you very much. Øystein, just to go back to you, when you saw what was your reaction to the TPI and to that additional tool in the toolkit? It's interesting that we are talking normalization, and that's very important, but also if the TPI allows the ECB to and allows the central bank to continue along the road without having to do a U-turn while they're normalizing and seeing the unwarranted spreads, then perhaps then what was your reaction to whether you think that this is the correct tool for that path?
On this issue, I think I should be relatively careful in the sense that, well, let me first say that I was governor also when the phase 2 of the financial crisis in Europe. We have experienced policy being very expansionary in Europe, in particular being the only player in town for many years at least. And let me also be very clear on the fact that I very much respect and I'm humble as regards the conduct on monetary policy in a monetary union, which is quite far from being what economists characterize as an optimal currency area. So, I mean, I have full respect on what's been done back 10 years back to the Euro crisis, where the ECB did whatever it takes to manage the situation. Since then, we all know that monetary policy has remained very expansionary. rates have remained low, and monetary policy has been supplemented from that back to that period by the QE policies. And what's originally was called unconventional policies. Now, what's happened during the last 10 years is that these unconventional measures, in my mind, seem to be normal, be part of the normal toolbox. And again, there are many reasons. I'm sure there are good reasons for implementing the last measures, the TPIs. But I personally, I'm worried about just the brief history I now described. Monetary policy has for many years taken on board a number of responsibilities. Complexities in the conduct of monetary policy have become much more pressing. And I wonder what's how the major central banks and ECB in particular is going to leave. When are we going to make monetary policy more conventional again? That's the big dilemma, I think. It is related to the fact that in many camps, both in the private sector, but also by many governments, debt levels have risen to very high levels. You cannot escape from that fact that that's underlying also the actual conduct of monetary policy. And I understand the dilemmas, especially for ECB, but I worry personally. I worry about the focus on QE policies these days.
Thank you. I think that's a key question. The unconventional monetary policy is now conventional, and actually, what environment do we currently operate in? I think that's always something to unpack further. Didier, I'd like to come to you and perhaps put that question to you as well. What's the market reactions to continuing and expanding the ECB's toolkit? And also, I'd like to ask you about your concern about the Italian spreads, and also as we look to the Italian political uncertainty that obviously with the Prime Minister Draghi's resignation.
The first point, an important point, the ECB's bold move would not have been possible in terms of rates if the ECB had not at the same time, launched this TPI program. The first market reaction on BTPs was favorable. That being said, the fact is that the way we analyze it, it's a program that it's not in a whatever it takes mode. My point, it's a stabilization QE, it's not a monetary QE. And we expect this TPI to be, I would say, more reactive than preemptive. What does it mean in practice? The political crisis in Italy was not taken into account. And my point is that it's not the mission of the ECB to intervene, to avoid the pressure on the Italian market that could arise given the political tensions that we'll see in the coming weeks in Italy. So my point is that the bar is quite high for the ECB to activate the TPI. And when you look at the conditions, for instance, there are strong, I would say, conditionality. There is a strong conditionality. I mean, with a commitment, that to respect the recovery and resilient plans, and there is a clear reference to fiscal sustainability. My point is that in this environment, as long as you don't know what the next fiscal policy will be, the ECB will be probably reluctant to intervene directly on the Italian bond market. So we expect clearly the BTP market to remain very volatile in the coming weeks and months. But we also believe that the ECB, with this powerful program, has the means, in fact, to intervene and to fight dysfunctional markets. In particular, if you have some contagion on other peripheral markets of what's going on in Italy, we would expect the ECB to intervene, and investors really believe that. If you have too much pressure also on private securities, some corporate bond markets, due to the monetary policy normalization, if it's not related to fundamentals, the ECB would have the means, in fact, to intervene. Interestingly, this program is very much like the S&P 12 years ago. I mean, it is open both to government bond markets, to peripheral bond markets, and to private securities if needed. And we clearly understand the difference, between what a stabilization QE is But we also understand that the bar, as I said, is quite high to activate this TPI. So regarding Italy, we are, I would say, worried for the coming weeks. You know that the elections are planned for the end of September. Looking at past political episodes of elections, it takes time to form a government after the election. So we don't expect the government to be formed before, let's say, the end of October or even mid-November. And it's too late, I would say, to deal with the fiscal issues. And so there are risks coming for Italy that fiscal policy will not be compliant, you know, with the rules. And that's, I would say, something that may generate a lot of noise and may generate some volatility. And once again, investors should not expect the ECB to intervene if what you see on the BTP market is related to uncertainty about the next fiscal policies, the upcoming fiscal policy coming from the next Italian government. So volatility is on the cards, but we are quite confident that the ECB would act to counter financial fragmentation on other market segments, either other peripheral markets or even credit markets, should it be needed.
Thank you very much. I guess that's where the unwarranted word comes in, which is quite key for the conditionality on the TPI. Katrin, do you want to respond to anything we've just heard before we move on to talking about productivity and growth?
Yeah, brief comment. Of course, the unwarranted word is key because the ECB has not the means to fight fundamentals, but of course, the ECB can influence whether markets coordinate on a benign or a bad equilibrium. And they shouldn't coordinate on the bad equilibrium. And of course, the ECB is very much aware that monetary union is incomplete. So we don't have banking union, we don't have fiscal union, we don't have capital markets union. And that is one reason why these spreads can arise. And that's one reason why the central bank is stepping in and monetary policy is used to contain these spreads, which is probably not the optimal assignment of government instruments to this problem. And I would also like to say that regarding eligibility, it is said that the Governing Council will consider accumulative lists of these indicators. And these indicators are, as Didier has said, the compliance with the fiscal framework and all these things. But in the end, it's the discretion of the Governing Council who takes the decision, taking into account all of these indicators, but it's not a mechanical way how the decision is tied to the evolution of any of these indicators, just to say. And also, the purchases are unlimited ex ante. So I think the TPI, in fact, is a very powerful tool.
Thank you very much. And I want to end this fascinating discussion with you all by talking about productivity and growth, and specifically the future for Europe within green energy. So Didier, the fostering productivity and growth, looking towards ESG investing, do you think that this is an area for Europe to really delve into and to offer the growth within Europe, and how can that be bettered? What is needed for that investment to really prove that Europe can be that key player, which it definitely is currently on the world stage?
Yes, that's true. In fact, there is a shift, in fact, toward responsible investment of the past. We saw that over the past 5 years. And clearly, asset managers are at the forefront of this shift. Responsible investment has been increasing very strongly over the past 5 years. So we should put things in perspective. We believe this trend will continue. And it's only the beginning. It's not just a trend, but a profound change that is really needed. But now you have many challenges to address. First, organize the market, develop an ecosystem, with data providers, rating, build standards, increase transparency. I think it will take time, but we need to make progress on this in this direction. The important point is that the pandemic, before the crisis that we are seeing, the pandemic was a turning point for sustainable finance, because many people, are now more aware of the risks linked to the ESG issues and the need to address them, these needs very urgently. So the imminence of risks linked to the climate change were perceived before as distant. They are now, at the core of investment behavior. And having said that, there is still a lot of progress to be made on ESG, data collection and on normalization, on ESG analysis. It's a long road. It's a long road. But we have made, if we put in perspective, we have made a very strong progress over the past few years, and we will expect in the coming years this trend to continue. As an asset manager, as you know, we were an early mover, and we really strongly believe that we need to support the development of this ecosystem of ESG data provider, which is, as I said, very much needed. Now, turning to the energy dependency, it's clearly vital in this environment not to pivot away from the fossil fuels source to another. I mean, it's going to be a complex task in the coming 2 years to achieve such a. And an important point also that we have in mind is that to achieve the transition, it will require massive additional investments. And policymakers, together with all economic actors at every level, need to tackle these challenges. In fact, policymakers also need to ensure that this transition is inclusive, because we were talking about productivity. If you think about productivity and growth in the medium run, it will be clearly related to inclusive growth and to an inclusive transition. Otherwise, the social conflict would undermine our ability to transition. And that's a very important point. So the inclusiveness of this transition is quite important. Massive investments require an action from both policymakers, but also because we just talked about, the capital market union. The capital market union is really needed. We need both private capital and public capital in order to engineer a smooth transition in the coming years. And massive investment, an important point, are really needed to support a green and increasing recovery, in particular in emerging markets. The bulk of CO2 emissions growth in the coming decades will come from emerging markets. And it's clearly there that also we need to monitor the progress that is made. So to put it in a nutshell, it's going to be difficult in the coming 18 months to accelerate the transition, but there is no choice but to act more quickly than we had expected on this issue. So an inclusive program, and both a strong coordination between public actors and private actors in order to channel, excess savings in the Eurozone toward investment projects that are very much needed. This is the only way to boost in the medium run potential growth and productivity growth.
Thank you, Didier. And Øystein, I want to come to you because I want to ask about how do we ensure energy security. Obviously, Norway has a huge stake within Russian gas. It's reflected in Germany as well. But it'd be interesting, I think we've had conversations recently about whether the shift away from Russian gas into sort of the coal and looking at actually the more immediate need to just fund the energy, to just facilitate the energy market, what implication that has on the medium to long-term transition to net zero. So Øystein, give your perspectives on the current but also future environment.
Well, again, I have already touched upon, and we all, through the news these days, are worried about the issues of energy security and what's happening with Russian gas, what should happen with Russian gas in the longer run, and also in the shorter run, what's happening the coming winter. And I'm not in a position to be 100% informed, but I have followed from this last month's the policy change. It's a game changer when the Commission, I think it was in early March, declared that they have a plan, in spite of the problems that will create for consumers and also in industries. They have a plan to cut and to get completely rid of, move away from Russian imports through a decade, and to take a major step already this year, the coming year. The latter ambition, that could not happen. I mean, they have an ambition to reduce 2/3 of their imports from Russia through the coming year. Well, that could not happen voluntarily. I'm sure. Although I have listened to the fact that there's a buildup of gas storage through increased LNG imports, and in the short run, that has to be the increased imports of LNG, liquefied natural gas, has to be part of the solution. In the longer run, of course, this what's happening and the increased focus on energy security has made it even more important, as Didier just mentioned, to speed up the green transition. But that is a longer term perspective, because that will take time. And on that, I think earlier I said that this crisis has been mounting gradually. One major as a starting point, the high energy prices and gas prices in particular were a result of actually a market reduction in overall investments in energy supply, in spite of increased investments in wind power in many countries. That could not compensate for the strong decline in investments in more traditional energy producers. So that was the background for the high prices. And of course, I think there's a lesson here. The green transition is coming. The climate problem is urgent. We have to respond even more quickly and strongly than we have done so far, but there will be a cost. Energy prices will remain high. That's an inevitable consequence of the green transition. So to some extent, although the war comes on top of that, and we all hope that goes over, but the high energy prices will not go away. So consumers will have to experience and will have to pay more for energy than we have been used to previously. That's inevitable.
Yeah, thank you very much for that perspective and putting it within the context. I think that's extremely helpful. And I come now to my final question to Katrin, and I want to thank all of you. But Katrin, I want to ask you around the growth prospects for Europe, the euro area, and also looking to the long term. When do we see inflation getting to that coveted 2%? This is very much from your perspective. Obviously, you're here in your own capacity. So thank you.
Yeah. So it's extremely hard to predict growth over the medium term. So we have our projections, and we see there are so many contingencies. You have to take so many assumptions to get to these projections. So just let me name a few. That's first, gas, as Øystein has already said. Will gas have to be rationed over the winter, and how will gas supplies evolve, which is largely a political question, and it's very hard to predict. Then we have these supply side bottlenecks still ongoing, and also there we don't know how it's evolving. So the economy is improving as there is some pent-up demand, but it's mainly in services. So we see that services demand is very strong, especially now in summer. So with the tourist season, people are traveling, people try to make up for the years that were lost during the pandemic. But how will this evolve, and will it persist? And on the other hand, we see that manufacturing is not doing so well. And there it's very hard to predict what will be the effects of the pandemic in fall. So will we have another wave? So now in summer, it looks like we are getting through that, and infection rates are relatively benign, or at least hospitalization rates are benign. But will this persist into fall, and how will the authorities respond? So there is a huge uncertainty for the second half of this year. And this is, of course, extending into the next year. And this, of course, will have an effect on inflation. So with the lack of demand, then inflation will also evolve more sluggishly. And monetary policy tightening is, of course, also geared towards lowering demand, which is more difficult at the moment because part of it is this pent-up services demand, and part of the economy is already slowing. So inflation will be dampened by the monetary policy reaction, but of course, monetary policy can't do anything against high energy prices. So this is something that will feed through into inflation, and what monetary policy can react to is second round effects. And we are, of course, monitoring that, but at the moment, our assessment is that it's still benign. So we do see wage increases that are one-off, and this is not the definition of persistent inflation. So if it's one-off, it's kind of a reshift of purchasing power, but it's not persistent inflation. So once it feeds into indexing and persistent increases a wage price spiral, then of course monetary policy has to react. And the longer inflation is increasing and very high, of course the risk increases that this will feed into more persistent inflation. And this is the reason why the ECB is acting. So overall, the outlook, as has been said also by Didier, is not very benign. It's not very nice. We have a slowing growth and increasing inflation, but the monetary policy reaction will help to bring down inflation. And yeah, in the medium term, we would also see, when the supply side bottlenecks have been resolved, when the economy has normalized, there should be some pickup in growth again. But this would be for the longer term. So in the near term, we do see a slowing of growth and an increase in the inflation outlook.
So we are still in a lot of uncertainty, but everyone is navigating this as seemingly still quite well, I would say, is the summary, that we are all trying to make sure that there is a flexibility to respond quickly to crisis, but also staying the course as far as possible to calm markets and to also ensure that there is credibility within these institutions, which I think has been managed very well over the last few years. So we look forward to continuing these discussions. I'm absolutely certain that the macroeconomic environment in Europe will continue to have questions, be volatile, and that listeners will still be interested in hearing what all of you very experienced speakers have to say. So thank you for joining us. Thank you very much to Katrin, to Didier, and to Øystein. It's been a pleasure to have these conversations with you and to continue. So thank you very much.